today is a special day. We have the 10,000, so thank you to be here for our Ethereum project. And also thank you all, because we have already the next meetup as Thursday. It was a special vision for me to bring Melonport here. It's great that Mona and her team have time today. For me, it's one of the very exciting projects from the Ethereum ecosystem. Melonport did the token sale in February. They raised 2.9 million. What, if you think about today, is not a big amount. It has been 227,000 Ethereum. The token sale was sold out in a few Ethereum blocks, so it was with a hard cap. It was done in 10 minutes, so quite, or even before. It was in the first block, have been 99% of all sold out. And today the market capitalization is 47 million US dollar. And I don't want to say more here. I just want to thank the sponsor, Ernst & Young. Thanks a lot for giving us the possibility for a room. It's always difficult to get rooms available in Zurich. It's not easy to find something what is affordable. Because we don't charge any fees, so it's always should be free. And special thanks also to our community manager Roger, who have done a lot here and also making here the video. And I will hand over to Mona now and give her a warm applause and Melonport. Thanks.
Thank you very much. It's a real pleasure to be here, and also thanks on our behalf to all of you for making it here tonight, and to the Bitcoin Association, and of course to E&Y for the great space. It's good to be in Zurich. I'm going to start off by giving you a little background on myself and Melonport. So how did I come to Melonport? So I actually came from the hedge fund space before I started off my career as a trader at Goldman Sachs for 8 years. I then moved to the hedge fund world as a portfolio manager at Jaber Capital in Geneva for 4 years, and then I tried to launch my own hedge fund. That was actually here in Zurich. It was a long-short equity fund. I raised $30 million, and then was faced with the reality that if you're not in a huge institution with floors of people taking care of operations, booking trades, reconciliating trades, managing the P&L, hedging trades, booking FX, etc., etc., it's pretty hard to survive. And actually there's a Citibank report a couple of years ago that says the barriers to entry in hedge fund management today are $200 million to launch a fund. Anyway, I decided to close my fund after a year. And I decided to take a year off to explore what technologies are there to exist in order to make this process a lot more efficient, because I couldn't believe that we're still booking trades with pen and paper and they're settling T+3 in this day and age, and it seems a little bit crazy. So for today, I'm going to give you a quick introduction on Mellon. For those of you who don't know, Mellon is a protocol that allows you to set up and manage a technology-regulated fund in the future vision of how I see, or how we see, asset management. I'm going to take you for 2 seconds through the Bitcoin to Mellon, you know, where we started and where we are today. Maybe for those of you who are wondering why you're here, kind of a couple of slides on why you should care. A little bit of in-depth detail on the protocol itself and where we're at today. I'll describe the Mellon token, which we get asked about a lot, and what its functionality is in the whole ecosystem. And then I have some closing remarks, and I promised that we would show a demo. Unfortunately, we cannot do a live demo today because the Cohen test net is, the gas limit is slightly below what we needed to be to deploy the contracts, but we have a pre-recording and we can give you a live demo on another part of the protocol. So without further ado, just maybe I hope there aren't that many beginners in the audience, but if there are, just a quick recap of where we're at today, where we came from. I guess the Bitcoin who now we all know, of course, was invented by Elon Musk, was basically the introduction to us for blockchain accounting, the idea of being able to transfer a digital value from A to B and in an extremely secure and fast way with close to zero transaction fees, which was extremely revolutionary with this blockchain accounting mechanism. Ethereum takes this and embeds an entire coding language within it and gives us essentially what looks like a blockchain computer. When you have what looks like a blockchain computer, the next logical step is to build software on that computer, and that's exactly what we at Melonport are doing. We are building software that allows you to set up and manage a technology-regulated fund. Other examples of what blockchain computing has allowed us to do is obviously issue digital tokens, which we've seen a lot of in the last year, code them to do cool things, and technology-regulated investment funds is obviously what we're doing. And I guess maybe just a word on how we see the future. At the moment, we are able to interact within the Mellon protocol in a decentralized way with all the ERC20 tokens. The future, what we see is all these blockchains that have emerged since Ethereum being able to communicate with one another in what can be described as the internet of blockchains, or the internet that hooks up all the blockchain computers. So I guess why we should care? I mean, it's actually almost feels unnecessary to make this argument on a day when Bitcoin hits 10,000. But I'm going to quickly go through it anyway. I mean, we've gone from 0 to 275 billion market cap since 2009, completely uncorrelated returns without having to change the rules. And I guess the remaining question we have at Melonport is, we fundamentally believe this is an asset class. We saw resistance before from Mike Milken, from John Bogle when it came to ETFs. Mike Milken, when it came to junk bonds in the 1980s, people thought he was crazy when he started saying junk bonds are actually an investable asset class. Same with John Bogle when it came to ETFs. Commodities as little as 20 years ago were seen as an uninvestable asset class until Goldman Sachs pioneered the space with the GSCI index. And emerging markets as little as 15 years ago were seen as untouchable. So for the non-believers, I guess at Melonport we obviously believe that crypto tokens are the new asset class. And the question is, we don't know who's going to pioneer it. We're seeing a lot of interesting hedge funds pop up in the space. But what we do know is that there lacks an infrastructure to manage crypto digital assets, and also there lacks rules and regulations, to manage these in a kind of coherent way. And therefore, we can't sit here and predict who's going to pioneer the space, but we can predict that they will be using Mellon to do so. Just as a little statistic, I guess, whereas as little as 9 months ago, we were maybe getting 3 to 4 phone calls a month from unsolicited phone calls from crypto hedge funds. In the last 3 to 4 months, we get, Hansen can tell you, he's our external relations guy, maybe 70 to 80 calls a month now from new crypto launches who are exploring whether they can use Mellon as a platform. And if I haven't convinced you that crypto tokens are an asset class, or altcoins, whatever you want to call them, I think that the infrastructure we build will also be able to be used on traditional hedge funds too. I fundamentally believe that every single asset we know of today will exist in a tokenized format one day. We're already seeing evidence of it, with Daimler announcing this first corporate bond on the blockchain about a month ago. We've heard from several central banks exploring the idea of putting fiat currencies on blockchain, and this is just 3 examples. Neufund, Gibral Network, and Autonomous are companies who are looking to put equities in a regulated format on the blockchain, which is great news, because for all the people who aspire to be hedge fund managers, if we can get all of this digitized, then suddenly the barriers to entry go down from $200 million to much, much less if you can do this in a digitized format. So, what is Mellon? This is our new Mellon logo, and I'm going to, give you a quick taster of what the Mellon protocol is for. So, it enables you basically to do 4 main things. So, the first is it allows you to set up your fund rule set or structure, and by that I mean in code it allows you to predefine which exchanges you want your fund to interact with. It allows you to predefine your asset universe, so which tokens or which digital assets is your fund allowed to interact with. Where does your fund get its data feed from when it calculates the NAV, the net asset value, and also performance and management fees? You know, we predefine this data feed so that there's no room to corrupt it or change the rules of the game halfway through. What are the fees that you want to charge your investors? So rather than using accountants and fund administrators to calculate these fees manually and distribute them, you can now automate this using blockchain accounting and some formulas that we've coded into the smart contract, and you can just plug in the performance and management fees and the rest is automated. Participation, by that I mean who's allowed to invest in your fund, so you can predefine which addresses are allowed to invest in the fund, and you can have an external KYC AML provider on that. And finally, another exciting one is risk management. You can predefine a lot of these rules, but regulations, as funds get more and more regulated after the 2008-2009 crisis, more and more rules and requirements are requested. Some of them, like a UCITS fund, for example, requires that you can't invest more than 5% of your AU assets under management in any one particular asset. So you can code these risk management rules in, instead of having a human being who may have a conflict of interest because he's being paid by the fund manager himself to look over the fund and make sure you don't break any of the rules. You can actually have them coded in the smart contract and enforced by the blockchain. So Mellon protocol basically allows you to predefine all of these things, and the blockchain enforces those rules on the fund manager. Obviously the rules are also fully transparent. So the other thing that the protocol allows you to do is create a transparent, visible, and auditable track record on the blockchain. This means that I think at the moment to deploy a Mellon fund on Ethereum is costing about $35 in gas. It's unfortunate that it's that much. A few months ago it was just a few cents. But still, if you think about what it costs to launch a fund in the traditional world today, you're now using Mellon, able to do it in under 2 minutes and for $35. That's a big, improvement already. But our goal is to drive that cost down further and also to enable it to happen faster. And finally, fund distribution. Again, the process of investing and redeeming from a fund is very cumbersome these days. So what you can do with Mellon is actually the technology automates the whole process. Meaning if I deploy a fund to the blockchain, this fund with its rule set takes the form of a token itself. If Hansen wants to invest in that fund, he sends a digital Mellon token to the fund. The smart contract creates new shares in the fund or new tokens in the fund and sends them back to Hansen. Now the cool thing about this is in the real world, when you invest in a fund, you have a third-party custodian who looks after all the assets. In this world, Hansen has full custody of his assets at all time. And at any point, if he wants to redeem from the fund, no one is there to stop him. Whereas in the crisis, as you know, a lot of people were not able to redeem their investments. So how does it work? Maybe just from a design perspective, what you see in the middle is the Mellon fund contract. That's the only part of the protocol that's absolutely compulsory. The reason it's compulsory is because this is the part that has to be extremely secure. This is where the assets under management are held. This is where anyone sending money to the fund, their assets will be stored here. There's only 2 ways in and out of the Mellon fund contract. That's invest, redeem, and that's trading with any predefined exchange. Other than that, the contract is designed to be extremely secure. Everything else is modular. All the stuff we just mentioned about exchanges, asset universe, data feed, etc., that's modular. And the way that works is we have different module classes. For example, in data feed, we provide templates for those module classes. So for a data feed, template would look a certain way. And then providers, data providers or data service providers can follow that template model to link to the Mellon protocol. So as an example, we recently had, actually first mover was Oracleize. They linked their data feed to the Mellon protocol, which was awesome. Just after that, CryptoCompare linked. to Mellon Protocol, and most recently we're very proud to announce that Thomson Reuters integrated an oracle as well into the Mellon Protocol. As a user, when you're setting up your fund, it will feel like being in an app store, and you have a selection of price feeds, and you say, I want the oracleized price feed. I want the Augur asset universe and maybe the Like asset universe. So this is a set of assets that is defined by those two companies. I want a FINMA compliant risk management module, for example, and I want these 10 addresses to be allowed to invest in my fund. And I want a 2 and 20 performance management and performance fee. And you deploy this set of rules to the blockchain, and if it's the Mona Capital token, for example, this token now exists on the blockchain, and anytime someone invests in it, it creates new shares. So that's basically how it works. And maybe on a slightly more technical level, I'll just go through, I hope you can see that, it's not too small, but if not, it doesn't matter. How does it work in a governance kind of design? We've just deployed version 0.5.2. That's the latest design. I think the front end is slightly behind that. It always takes a little bit of time for the front end to catch up. Essentially all funds that are launched on the current version will link to that version. And every time we release a new version, all the funds will get shut down. But it sounds complicated, but it's actually just a click of a button, and then you can redeploy it on the new version. And basically, anytime you want to modify the code and upgrade, once we go live and we deploy to the mainnet, you'll have Mellon token holders will be able to elect a technical council or a group of maintainers who can maintain the protocol and receive incentives for that, as will some of the module developers. So that brings me nicely to what the Mellon token is there for. The main goal of the Mellon token is really to incentivize further development. When we set out to build the Mellon protocol, we realized that the asset management industry is humongous, and there's absolutely no way we can conquer it all on our own. And one of the reasons we wanted to issue a token was to create the network effect and to create the incentives to build all the necessary modules to meet all the necessary jurisdictions and regulatory requirements, etc. So there's basically, once we narrow it down, once we started developing, we basically realized there's 3 areas where we need to continue incentivizing development. One of them is participation, so outsourcing the KYC AML to module developers or people who are already in that space to link to the protocol. There's obviously a lot of cumbersome work that goes with that, especially depending on the jurisdiction, some more than others. And so the idea of Mellon protocol is once you deploy, there'll be an inflation. Just as you have an inflation with Bitcoin, you have an inflation on the Mellon protocol, and the inflation goes towards paying the module developers and the maintainers. So in Bitcoin and Ethereum, it goes towards paying the miners. In the Mellon protocol, it goes towards anyone who's adding value to the network or maintaining the network. So that's the first category that we want to incentivize. The second is data providers. What we have learned with all 3 data providers, Oracleize, CryptoCompare, and Thomson Reuters, is that they need to have a business model, and nobody likes giving data away for free. And so the idea is that maybe they would be more open to it if they were receiving some kind of incentive. And Mellon tokens is what we predict to be as the incentive. And finally, risk management is probably the most challenging, another very challenging one, maybe the most challenging, because of all the different jurisdictions and requirements and types of funds, and et cetera, et cetera. These have the potential to get quite complex, and we want to incentivize. We built a couple of really cool ones already. One of them is linked to best execution. So if the fund manager, for example, tries to trade plus or minus 5% from the true price being brought to you by the predefined price feed, it rejects the trade. So we try to enforce that the manager trades close to the real price and doesn't try to embezzle the funds by trading at the wrong price. And then if we flip it, so that's one of the reasons we decided to have this Mellon token to incentivize future development. If we flip it, what's the use case of the Mellon token? The first use case is that it allows token holders to elect a technical council. What we learned from the DAO is that in general, most people are apathetic towards voting, even when it comes to saving themselves. That was a really big lesson for people in governance. I think the DAO didn't even manage to get 11% of votes, and they only did 25% to save themselves. So what we thought would be more sensible would be to allow token holders to elect people who will take care of these decisions on their behalf, but of course also give them the right to kick them out if they misbehave or are seen to be doing not so good job by the token holders. So this is a subject that we still have further research to do in coming months, but yeah, we'll keep you updated on that. And lastly, last use case of the Mellon token is participation. So in order to invest in a fund, the native token required is a Mellon token. So you basically need to send Mellon token to the smart contract in order for it to issue new shares in the fund back to the investor. Yeah, and it's also performance is measured against the reference. The default reference is Mellon. So if your fund is up 100% and Mellon is up 50%, it will benchmark against Mellon, not against US dollar or whatever. Cool, so what does this mean? Basically means that by lowering the barriers, we can get better performance due to much lower barriers to entry. We can charge much lower fees to the investors. So today, I think the average hedge fund performance is 6 to 8% if you're lucky, but then that's gross. So you minus the 2% management fee, and you're looking at 4 to 6%. With Mellon, we think you can strip down the cost substantially, and therefore net performance starts to look much better. You get transparency around fees, which I think is very important. That means that you can see where your fees are being spent and on what. Totally reduce the need for the middleman. This is a challenge that we still have to face because the current law states that most funds need a custodian and a fund administrator by law. Mellon, I think, aims to disrupt both of those in the chain, and therefore we recently founded a multi-chain asset managers association, which is there to lobby and fight for a change in legislation to be more appropriate to blockchain technology for asset management. We announced that about a month ago, and I think we saw 60 founding members already, so there's definitely been a big advantage in terms of having a united voice. It also gives you transparency of investment products. Now that's something I think the industry is really lacking at the moment, all financial products, not just hedge funds. And of course, when you have full transparency report and immediate settlement, reporting to the regulator becomes much easier. So most importantly, if I had to summarize everything I just said, Mellon basically gives you a basis to set up and manage technology-regulated funds. Now I'm actually I'll finish here. So if you think you don't need that, maybe just a quick reminder of how something like Mellon Protocol could have prevented Madoff. For those of you who don't remember, this was one of the biggest Ponzi schemes in history. Investors were sending money to the fund for years, and Madoff was never buying any securities whatsoever with the funds, and actually it was just literally kept taking on investments and paying out from previous investments. If we just replay how this scenario would have looked like actually maybe just a couple of more things. The SEC was notified about highly suspicious behavior by Harry Markopoulos in a great report, and for whatever reason ignored it for a couple of years before it was truly uncovered. Now, reports suggest that one of the reasons that it was ignored was because of massive conflict of interest. So someone at the SEC was distantly related to, or maybe closely related to, Madoff's inner circle. And also people within the Madoff fund were very much within his inner circle. And so a lot of conflict of interest existed. If this fund had been technology regulated, there would have been no room for conflict of interest. The rules would have been predefined, and the blockchain would have enforced them without any emotion whatsoever. And I think that's really a nice striking difference. If you want to read more about that, there's a blog I wrote on it about a year ago, which goes into much more detail. Another example, slightly different, is Lehman Brothers. If we go back to the cause of what caused Bear Stearns and Lehman Brothers, it was all to do with lending money too easily without taking any collateral and to the wrong people. So very often these loans were being made without taking any collateral to people who clearly couldn't afford to pay them. But again, there was conflict of interest because real estate brokers were paid on commission, so they didn't really care if the person could pay the mortgage. They just wanted to sell. If you had structured your loans in the form of a smart contract, which required X amount of collateral before you could take the loan, and which put that collateral in a smart contract locked, in the case of defaulting on a payment, the smart contract would pay to the original lender. Again, you would have really massively reduced some of the risks involved, and you see some really interesting players in this space, in the leverage space, using smart contracts like Variable in France, and also Lendroid, and yeah, there's a couple of other people working on interesting solutions like that. But these are all solutions that can be integrated as asset universes into the Mellon protocol. So in summary, Mellon protocol gives you security, transparency, and if the investors choose, they can have custody of their assets at all times and redeem anytime they want. They don't need anyone's permission. So anyway, thank you very much, and for all your questions.
Thanks, Mona. It was a great performance and showed me a very interesting project. Mr. President, welcome. We have always a very active community regarding the Q&A session. So let's start. Mona is still here for questions.
Mona, thank you for your interesting talk. I enjoyed your way of explaining how investment funds could be managed in the future. Did I get it right? Whatever was tokenized, so whatever can be tokenized and is made exchangeable at one of the exchanges linked to the Mellon protocol could be subject to a Mellon fund.
Exactly. It can be an asset tradable within a Mellon fund. Yeah. So that's, I guess, a limitation, that the protocol can only interact with digital assets, but I guess one of our fundamental beliefs is that's the future, and we see all assets, regardless of whether they're equities, bonds, crypto tokens, governance tokens, whatever, real estate tokens, all becoming digitized just because it's more efficient in the way we do things today.
Just a quick follow-up on this, is it ERC20 only or all digital assets?
Starting as we have it right now, it's ERC20 tokens. One thing that I didn't mention is, so we are currently, the first deployment will be on Ethereum, and we're aiming for February next year on the mainnet. But after that, we have plans to build a faster, cheaper chain with more sophisticated governance in it, and that would be called the Mellon chain. So the first testnet version of that will be available in the coming days. And the idea of Mellon chain is that we can use, well, depending on the progress of Polkadot, if Polkadot's ready in time, we can use the Polkadot system for interoperability to hold tokens off-chain in a decentralized way. If Polkadot's not ready, we can use another kind of solution like oracles or break-in, break-out contracts, which we've done a lot of work on that, and we think both options are good. But that's kind of the work for that really begins after we deploy on Ethereum.
Do you have a timeline on like inter-chain operability?
Yeah, I think if we succeed in launching in February, I think the interoperability and Mellon chain will be available 12 to 18 months. I would say 18 months to be cautious after that. And by the way, maybe just a couple of other words on that. We really want to make this as cheap as possible for people to use. So the idea of Mellon chain is that the gas, if any, the gas will be much, much, much lower. And it will also be in the native currency. So it will, instead of having to hold Ether and Mellon, you would only need to have Mellon. The other thing is, unless Ethereum solves the scalability issue, the funds that will be able to create on Ethereum will not be able to handle high frequency or fast trading. And a lot of the guys we're speaking to have those kind of strategies in mind. So with Mellon Chain, you can start to work towards a more kind of high frequency use case. And lastly, so the speed was the second one actually.
How your own chain? How your own chain will mitigate the problem of scalability of Ethereum?
Because it will not be a proof of works chain. It would be probably a proof of authority chain, and the idea is the authorities maintaining the chain will be incentivized by the Mellon inflation. So you'll have authorities running those, maintaining the network, and making decisions about upgrades, adding, removing, modifying code. And they'll be nominated by the Mellon token holders, and they will receive incentives for doing so.
Lucas?
So you built quite a lot with just 2.5 or 3.5 million?
2.9.
2.9, okay. So what's your recommendation for the ICOs who make 10 million, 30 million, 200 millions? I mean, do they need that compared to what you already did with much less money? What's your opinion on that?
Yeah, I don't think it's necessary. I don't know about all the individual projects and what their use cases are exactly for raising all that money. But to the first impression is raising anything north of 5 million in an early stage doesn't really make sense. And rather, maybe it makes more sense to stagger, in phases after you've reached certain milestones.
Could you tell us a little bit about the economic model that Melonport deploys? I mean, this is all for free because in the end, somebody has to have some people using the Mellon protocol or whatever. Now are not going to have costs associated. I mean, it's not the cost of transaction, but the whole costs. How does that look like? Where do you earn money and who's going to pay for it?
Yeah. So we actually don't have a for-profit business model out of this, but what we do have is when we issued the first 40% of tokens to the public, the company received, I think it was 8% of the tokens, and those are largely still held by the company. Those we can use for any purpose, and obviously they've increased in value, so that gives us a fairly good cushion for whatever we choose to do next. And as long as as long as the price stays where it is, and then also ambassadors and corporate partners and advisors and founders were awarded, I think, 12% of tokens, but they were locked up. And so really, that's the only monetary advantage we may get, from the protocol. There's no fee structure. There's no, now I mentioned the idea of maintainers. I think if the community is happy with the work we do, there is a possibility that we get nominated as a maintainer of the network after deployment. And if you do simple maths, that's actually quite a good, just like it is efficient for miners to mine, it will be efficient for maintainers to maintain the network, as long as people are using the protocol. Because obviously, the value of the protocol will grow with the assets under management.
I mean, just because you're talking this is some serious business, talking about fund management. I mean, you come from the hedge fund space. Let's say this grows really big. We're talking, let's say, billions of assets under management. Mm-hmm. Then sustainability of the model and for the development of the protocols, it gets very substantial.
Yeah, but I mean, so do the incentives. So I mean, at the end of the day, the Mellon token holders always get to nominate the people who are maintaining the protocol. So if you have a technical council in place who's making the day-to-day decisions about the code, And if your prediction is right and the fund management protocol becomes worth billions, if you're assuming the 5 to 10% inflation on $1 billion, that's $100 million worth of incentives a year towards the maintainers potentially. So, you know, the incentives are there, and since the maintainers are being paid in the native token, they have an incentive to make the right decisions if they want that token to be worth anything. It's not fully hashed out, but this is kind of the thinking. We do a lot more work on governance next year.
So, are you running a fund on the protocol? You personally?
Not on this version. I'm running one on the previous version.
But
I will be in our first competition, which we're aiming for middle of December.
And your 30 AUM that you sent back, are they going to participate?
In what? In the competitions?
In your fund.
I should have mentioned the competition will be on the testnet, right? But yes, I would imagine. I mean, a lot of the people who are involved in that project are already supporting in many ways. Some of them even participated in the Mellon token in February without even understanding what it was, but just what the vision was. And some of them joined the association that we formed recently. So there's definitely been a lot of solid support from those guys. I mean, I guess they were the closest to me at the time, and they wanted me to succeed. Obviously, they wouldn't have invested if they didn't want me to succeed. But they also, it wasn't a really big surprise to them when I said, actually, I have to end this because I'm doing everything but investing your money. I'm actually doing admin full time. So, you know, if I come to them and say I'm working on a solution for this, you know, they were pretty open. Maybe a bit doubtful at first, but they're coming around.
Any additional questions?
Could you explore regulatory framework? Like, let's say I want to run a fund for, you know, fools, friends and family, and like I want to do it from the Switzerland, like using cryptography, I can be whoever I want, and but still I probably need to at some point talk with people in government in some countries.
Yeah, we're working on it. That's one of the goals of the association. So the MAMA, which is the Multi-Chain Asset Managers Association, formed in Switzerland, that has it's actually not public yet. But if you want more information, you can email what is it? Hansen@mama.global for now, because we're the first hire will start next week at MAMA. But basically, there's a document on the goals, but I can tell you from the last executive committee meeting, there's two top priorities for 2018 within the association. One is to determine and decide whether this law of needing a custodian really needs to exist in the world of blockchain, because for me, it makes sense when the token is related to a real-world asset, like real estate or equity or bond or whatever. But if it's just a utility token or a governance token, to me, it doesn't make sense. For me, actually, the whole point of crypto is that you are the custodian of your own assets. So we need to really make that differentiation clear and lobby for new legislation in place for new technology, rather than trying to fit new crypto funds, which they're all doing. It's painful to watch crypto funds launching, trying to fit into old regulation created for traditional funds, which wasn't created for blockchain, right? And instead of reducing costs and using all the technology available, they're taking costs up and making things even more inefficient, and using custodians and fund administrators who have no clue how to handle crypto as well. So that's the first goal, and the second goal is whether how much of fund management can we technology regulate? And we're going to be at the discussion table with regulators to educate them and to help form new legislation, which happens usually every time in history. Technology moves before regulation, and in this case, we decided to do technology first, like most people do, and then figure the regulation out later.
Thanks again. Sorry. One other question, a technical one. I mean, if I look at it from what I heard it first time today. For me, it looks like it's a very sophisticated wallet, sort of, for portfolio management of crypto, whatever currencies at the moment. Have you ever looked at another use case instead of calling it a fund for funds managers?
Yeah,
if it's just like for an individual to just run a portfolio of cryptocurrencies?
Yeah, but usually you don't have to technology regulate yourself.
Why would you have to regulate it yourself? I mean, if I just set up my own wallet, I also do the same thing.
Yeah,
it's just a more sophisticated tool.
You can use it for yourself, of course, but the real power in it is if you create a fund and you try to seek investments, why would I invest in you if I don't know you? And with this technology, you know, well, at least if I invest in him, he can only invest in these 15 assets. He cannot transfer the money to his personal account, for example. He can't run away with it, he can't trade at a wrong price because the risk management module stops him from doing that. He can't fudge the numbers because the price feed comes from Arclies, for example, and Arclies, you know, has a very sophisticated way of proving data is not manipulated to the blockchain. He can't only certain people, you know, so all basically all the rules are predefined. You can't charge yourself more fees than what we pre-agreed. You can put your fees into the smart contract, and you basically can't, you know, basically there's no way to embezzle the funds. So all of a sudden, I don't need, it's what Bitcoin did for accounting, essentially Mellon does for fund management. You don't really need to know or trust the other person on the other side. You can basically just, read the transparent smart contracts, and if you agree to the terms, imagine you had like imagine you had a 30-year track record on-chain, which was non-disputable, you know, because it's so transparent. And I could see the rules that you've been playing by. I've never met you, but I want to send you some money because you have a 30-year track record. You know, maybe...
But, I mean, I come from the hedge fund space too. I mean, it sounds all... I'm also from the hedge fund space, so it sounds all very, very reasonable. But I don't think the real problem is actually this. I mean, this is a great solution for what problems we have in the hedge fund space once you want to talk to investors. But the big problem here is to get from the real world to the digital world using this. I mean, how do I get there? And the obstacles are not only about the technological side of myself. It's about, as you mentioned, regulation and all these questions, which is trust by some totally different parties than the investor himself. I mean, if I have friends and family investing with me, I also don't have that trust problem. Of course, I have all the others. But so for me, I mean, this looks all great, but the big questions are really ones where can I take this into the real world? Also, the Mellon itself is obviously a hindrance because it's like an asset class traded in Mellon, and then the question is, who trusts the Mellon? You know,
I don't know. About that. I don't really know what you mean by the real world. Like for me, this is the real world now. Like going forward.
Yeah, no, the real world is how do I get my money in Swiss francs into the Mellon and from there into the wallets, and where is it safe?
If you invest, if you have Swiss francs and you want to invest in a US denominated fund, you have to sell your Swiss francs and buy US dollar to invest in the fund.
Yeah, but in between I have banks, and as an asset manager,
but here you
I
also
cannot
have
circumvent the banks. So
the bank just exchanges the currency for you and charges you.
Yeah, technically yes, but regulator-wise, it's a whole different story. I mean, I have to be regulated.
Okay.
I have to be regulated to run the fund. That's why the World Fund for me is really like, ooh, no. As soon as there's a fund, we're talking about the collective investment scheme, and there's like piles of regulation about that, and I see the problem there. You know, to convince
but that will get. I mean, regulation will get solved. I mean, it's not going to be like this forever. It's just it's too new. Like maybe, but you know, I mean, when Rockefeller started in the oil industry, it was unregulated for 50 years. You know, before real solutions were found. In the meantime, you know, a lot of people made a lot of money in the oil business. It doesn't. I mean, it will get solved. You know, people always start somewhere and work towards something. And where we are right now is that crypto hedge funds are trying to fit their structures into traditional, which is causing a lot of pain points, like you said. And you're starting to see people charge 3-4% management fee and 40% performance, which is crazy, more than in the traditional asset world. But you know, once regulation gets solved, it will go back, and you'll see a much more efficient industry, I think. And for the point of switching assets, I mean, crypto exchanges are only getting more and more liquid every day. I mean, so whatever is hard to, you know, it might be hard to change $100 million of Swiss franc into Mellon today, but in 5 years it might be able to be done on the touch.
Last question.
It's more about use case in private banking.
Yeah.
I'm assuming in some time this crypto asset class is born and accepted by retail clients.
For sure.
And at the moment I see there are two spaces. One is the crypto space, and then the already mentioned or existing space for financial university investments. And but I do not see efforts to integrate it technically and also on the business side. Do you see there is some, or do you have...
In the private bank space, you mean?
Yes, in the private bank.
Yeah, it's just fear. I mean, you know, we're not talking about cutting edge technology, we're talking about leading edge technology. It's so new. You know, we're really at the beginning of the curve. In many ways, the hype and the movement and the price is far ahead of where we really are in terms of the technology. And, you know, we haven't solved basic problems like scalability or governance and things like this. And until those get solved, of course, no real big institutional player is going to put huge amounts of money, especially when it potentially disrupts a large part of their business model. But I guarantee you they're all looking at it very closely. And yeah, and the minute that they realize, damn, we should have gone for that, it's probably too late. So, I mean, it's a very good use case for private wealth too, because if I understand correctly, I'm not from the private wealth management space, but understand that this concept of managed accounts is very big. And if you think about, this is actually a very interesting use case, since the client always has full custody of his investments, in Mellon protocol, it actually looks more like a managed account technically than a hedge fund. And so, anyway, this is questions for the lawyers. I'm not a lawyer, but these are all questions that we will be debating with the regulator and back and forth in different forums in the next couple of years.
Next questions, please, with the refreshments. So, thanks a lot. Warm applause for Mona and Hans.